Do you find yourself constantly struggling to make ends meet? Are you tired of living paycheck to paycheck and constantly stressing about money? If so, then you're not alone. Many people struggle with managing their finances and finding ways to save for the future. But what if I told you there was a way to break free from the cycle of spending and start building wealth? In this video, I'm going to show you how to become an investor and stop being a spender. Hey everyone, welcome to my channel. In today's video, I'm going to share with you some tips and strategies on how to become an investor and start building wealth. Many people believe that investing is only for the wealthy or those with a lot of extra cash. However, that's simply not true. Investing is for anyone who wants to build a better financial future for themselves and their families. So let's dive in. Section 1. The benefits of investing. Before we jump into the how-tos, let's first talk about the benefits of investing. One of the main benefits of investing is that it allows you to grow your money over time. Instead of just putting your money into a savings account, which earns little to no interest, investing your money can provide much higher returns. Additionally, investing can help you build wealth and achieve your long-term financial goals, such as buying a house or retiring comfortably. Section 2. How to get started. So, how do you get started with investing? The first step is to educate yourself on the different types of investments that are available. Some popular investment options include stocks, bonds, mutual funds, and real estate. Each type of investment has its own risks and rewards, so it's important to do your research and understand the potential benefits and downsides. Once you've educated yourself on the different types of investments, the next step is to determine your investment goals. What do you want to achieve by investing? Are you saving for a specific goal, such as buying a house or paying for your child's college education? Or are you looking to build long-term wealth? Understanding your goals can help you determine which types of investments are best for you. At the end of this video, we'll be going over different tips on how to get started, so be sure to watch until the end. Section 3. Investing strategies. Now that you understand the benefits of investing and how to get started, let's talk about some investing strategies that you can use to build your wealth over time. Strategy 1. Diversify your portfolio. One of the most important strategies for investing is to diversify your portfolio. This means spreading your investments across different types of assets, such as stocks, bonds, and real estate. By diversifying your portfolio, you can help minimize your risk and maximize your returns over time. Strategy 2. Invest for the long term. Another important strategy for investing is to invest for the long term. Instead of trying to make quick profits by buying and selling stocks rapidly, focus on investing in assets that will provide long-term growth. This can help build your wealth over time and achieve your financial goals. Strategy 3. Dollar cost averaging. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, such as once a month. This can help you avoid the temptation to time the market and buy or sell stocks based on short-term fluctuations. Instead, you can build a diversified portfolio over time by consistently investing a fixed amount of money. Section 4. Investment options. Now that you know some investing strategies, let's dive deeper into some of the most popular investment options. Stocks. A stock represents ownership in a company. When you buy a stock, you become a shareholder in that company, and your investment can increase in value as the company grows and becomes more profitable. However, stocks can be risky and volatile, and it's important to do your research before investing in any company. Bonds. A bond is essentially a loan that you make to a company or government. In exchange for your loan, the company or government pays you interest over time. Bonds are generally considered to be less risky than stocks, but they also offer lower returns. Mutual funds. A mutual fund is a collection of stocks, bonds, or other assets that are managed by a professional fund manager. By investing in a mutual fund, you can diversify your portfolio and gain exposure to a variety of assets. However, mutual funds also come with management fees, which can eat into your returns over time. Real estate. Real estate can be a great long-term investment option, particularly if you're interested in rental properties. By owning rental properties, you can generate passive income and build equity over time. However, real estate investing also comes with its own set of challenges, such as finding tenants and managing maintenance and repairs. Section 5. Common investing mistakes to avoid. While investing can be a great way to build wealth, there are also some common investing mistakes that you should avoid. Mistake 1. Trying to time the market. Many investors make the mistake of trying to time the market by buying and selling stocks based on short-term fluctuations. However, this is a losing strategy, as it's difficult to predict the market's movements with any degree of accuracy. Mistake 2. Failing to diversify. Another common mistake is failing to diversify your portfolio. By investing in a variety of assets, you can minimize your risk and maximize your returns over time. Mistake 3. Letting emotions drive your investment decisions. Investing can be an emotional process, and it's important to keep your emotions in check when making investment decisions. Avoid making impulsive decisions based on fear or greed, and instead focus on your long-term investment goals. Section 6. Tips for getting started with investing. As promised, here are some more in-depth tips to help you get started. Tip 1. Set your goals. Before you start investing, it's important to determine what your goals are. Are you investing for retirement, for a down payment on a house, or for another financial goal? Once you've identified your goals, you can develop a plan for how to achieve them. Tip 2. Start small. When you're first starting out with investing, it's a good idea to start small. Invest a small amount of money and gradually increase your investment as you become more comfortable with the process. Tip 3. Consider your risk tolerance. Everyone's risk tolerance is different, and it's important to consider your own comfort level with risk when choosing investments. If you're risk adverse, you may want to consider investments that are less volatile, such as bonds or mutual funds. Tip 4. Use a robo-advisor. If you're new to investing or don't have the time or expertise to manage your own investments, consider using a robo-advisor. A robo-advisor is a digital platform that uses algorithms to build and manage your investment portfolio based on your goals and risk tolerance. Tip 5. Invest for the long term. Investing is a long-term game, and it's important to stay focused on your long-term investment goals. Avoid making impulsive decisions based on short-term market fluctuations and focus on building a diversified portfolio that will generate long-term returns. Section 7. Common investing myths debunked. There are many myths and misconceptions about investing, and it's important to separate fact from fiction. Here are some common investing myths debunked. Myth 1. Investing is only for the wealthy. Many people believe that investing is only for the wealthy, but that's simply not true. Anyone can start investing, regardless of their income or net worth. Myth 2. You need a lot of money to start investing. Another common myth is that you need a lot of money to start investing. In reality, you can start investing with just a few dollars, thanks to the rise of low-cost investment options like robo-advisors and exchange-traded funds, ETFs. Myth 3. Investing is too risky. While investing does come with some risk, it's important to remember that there are many ways to minimize your risk and maximize your returns. By diversifying your portfolio and using smart investing strategies, you can reduce your risk and increase your chances of success. Section 8. Final thoughts. Investing can be a powerful tool for building wealth and achieving your financial goals, but it's important to approach it with a smart, informed strategy. By educating yourself on the different types of investments, developing a plan that aligns with your goals and risk tolerance, and avoiding common investing mistakes and myths, you can set yourself up for long-term success. Remember, investing is a journey, not a destination, and it's important to stay focused on your long-term goals and remain patient and disciplined in the face of market fluctuations. Thanks for watching this video on how to become an investor and stop being a spender. If you found this information helpful, please hit the like button and subscribe to my channel for more how-to videos. And as always, feel free to leave any questions or comments down below. See you in the next video.